Crypto profits are exciting until the IRS comes knocking at your door. In this video, I'm going to share with you 5 of the top red flags that we see that could give you an audit and give you massive penalties for just being a crypto investor. And trust me when I say most people don't even realize that they're doing some of these things. Whether you're day trading, flipping NFTs, holding long-term, or staking, mining, airdrops, any of the above, it's super important to know what exactly catches the eyes of the IRS so you are more prepared before tax season hits. And don't worry, I'm not here to scare you. I just want to be able to show you exactly how to stay compliant, keep more of your profits inside of your pockets, and then also make tax season a lot less stressful for yourself. All right, so let's get into red flag number 1. The very first red flag is so simple and often overlooked. Is actually on the very first page of your tax return. Okay, we're gonna reference it down below. We have it pulled up. Here's a 1040. This is your personal tax return. And if you just scroll down just a little bit right after filing status, there's a section called digital assets. And this actually shows you that the IRS cares more about your digital assets than your dependents or your kids. They want that information first. So if we can see right here, the question is, at any time during 2025, did you A, receive as a reward, award, or payment for property or services, or B, sell, exchange, or otherwise dispose of digital asset or a financial interest in a digital asset? And that question is so simple, but people often do not get it correct as far as clicking yes or no. And they're simply asking, hey, did you have any of these activities that the IRS deems as a taxable event? So if you cannot understand that this is a taxable event and you are clicking yes when you had no sort of taxable event, because maybe in 2025 you held all through the bull market, well, now you're giving yourself an audit risk and giving the IRS the ability to go look at your tax return and see where is this missing information of a taxable event. Now, again, what is a taxable event? To break it down in layman's terms, based on that question is, have you sold any of your crypto? And that simply means converting it to USD. Have you also sold your crypto to another token? So simply converting from Bitcoin to, let's say, Solana, that is considered a taxable event. Even though you did not switch it back to USD, this is still considered a taxable event. And a lot of taxpayers, crypto investors, are completely blindsided and not aware that this is a taxable event. Unfortunately, don't hate me. I am not the authorities. I'm not the IRS. I am just the messenger and telling you, hey, this is what the IRS deems as a taxable event. So one, again, we've already determined switching to USD from one crypto to USD, taxable event. Switching from one crypto to another crypto, that is taxable event. If you decide to sell or exchange your crypto for a product or service, that is also considered a taxable event. And the last one, which we'll talk about a little bit further later in the video, is actually receiving crypto as income also. If you are doing some sort of service or you are going to be selling a product and you receive crypto, even though it's non-USD, that is considered income and that is considered a taxable event pertaining to digital assets. If you have had any 4 of those taxable events, you need to click yes on your tax return. So other activities that are not considered taxable event is simply just holding your crypto. That is not a taxable event. Moving from your crypto from one wallet to another wallet, that is not considered a taxable event. These are activities where you're not really selling your crypto. You're just simply moving that money. It's simply like moving your money from Chase Bank to Bank of America. There's a different account. There was no taxable event in this case. And like I said, the problem is that if you had a taxable event and you decide to click no, and the IRS finds out that you did have a taxable event, well, there could be some problems there. The flip side to that is if you did not have a taxable event and you didn't know about this information, but you click yes, you are supposed to provide that information to the IRS. And if you don't provide the information, but you click yes, well, now the IRS is wondering, well, what did you exactly do? Ding, ding, ding. Let's reach out to them. This is often overlooked and causes a lot of confusion with crypto investors, but these are things that you should know when you are getting ready to file your tax return. All right, that one catches a lot of people off guard, but the next red flag is actually even sneakier. You see, the IRS is paying attention to this a lot more frequently, and that is when crypto investors are claiming crypto deductions like they are a business. And that's actually a huge problem, because just you buying that crypto token and hoping it appreciates, just like myself, I do hope crypto appreciates in value. And I'm studying the charts at home in my home office. I'm going out to dinners and talking to crypto investors about this crypto token, or I'm traveling to events understanding the crypto token itself, doesn't necessarily mean I am a business. That just means I am a crypto investor and I'm buying into tokens that I just like, right? So how does this relate back to the real world? So for example, if you are somebody that is buying Tesla stock, right? You are nearly just a stock investor, right? You might go to events of revolving around Tesla and what they're doing. You might be doing additional research. When do I buy, sell my stock, whatnot? That's awesome. But that doesn't necessarily mean that you can write off everything related to you being a stock investor. The same thing applies to crypto, okay? Just because you are traveling to the event and shaking hands with developers and, meeting them, whatnot, and you're buying their tokens, hoping it appreciates, doesn't mean you are able to claim these crypto deductions by simply being a crypto investor. Crypto aside, deductions are meant for just business owners. And if you don't have a business revolving around crypto, those deductions that you're claiming are going to be very hard to prove and legitimate. And you're going to run into huge problems with the IRS when they do take a look a little bit further on what are these write-offs that you have. If that sounds bad, wait until you hear this next one, because this next one is something I see on every single tax return, and it is rounding your crypto profits, okay? There is never in any case where you are buying $1,000 worth of Bitcoin exactly every single time and then deciding to sell it at 1,500. If your numbers are too round on your capital gains and capital losses when you are putting together your return, this could be a problem, because there, again, in no cases where you are perfectly timing and selling your crypto tokens at the most round number possible. If you are constantly at $10, $5,000, $500, and $10,000 round numbers, buying and selling, disposing, and this is the case, this could be a huge problem, because then it looks like you are just rounding off and estimating your crypto gains. And this right here is something the IRS does not like. Same thing with business owners that constantly take deductions and round those numbers off. Is exactly $5,000 in marketing expenses, $10,000 in paying team members, $5,000 in traveling. These numbers are too round and can often cause the IRS to take a peep at your tax return and see exactly, are these accurate numbers. Same thing with your crypto profits, crypto gains, and then even like gas fees, right? Processing fees and transaction fees to get your crypto. They're never round numbers, okay? They're always like a fraction of an amount. In some cases where Coinbase does apply like a $5 fee for you buying USDC, those are those rare cases, but rarely do you ever see even numbers buying crypto and selling them. Real numbers are never perfect, and you should be aware of that and provide the most accurate information to the IRS so you don't raise any other red flags or concerns with them. Now, this next red flag isn't talked about enough, and if you're not careful, this will certainly most give you an audit risk, and that is not claiming income when you received it for doing work, for services, for product as crypto. This happens mostly when someone is in a service-based industry. So if you are doing some sort of service for another company, much like, and this is an example of a developer, helping a small crypto company, develop their blockchain or develop their Discord community or whatnot, they're doing some sort of service and then getting paid in crypto. A lot of times people and developers don't understand that just because I don't receive it in USD, this is not considered income. Unfortunately, whenever you do some sort of product or service, even if you get paid in gold or, a vehicle or whatever the case may be, you received income for doing a service. This is considered income in the eyes of the IRS, regardless of what that token is or what the product is. If you're getting paid something else wise, this is considered income and you need to report it. A lot of people get confused that just because it's in crypto and it can't be tracked, which is so funny because everything's on the blockchain. They say that it can't be tracked. I'm not going to report the income, and I'm not going to have a taxable event or have to pay taxes on it. You see, in 2025, if you received more than $600 for doing contracted work, you're going to receive some sort of 1099, whether it's NISC or non-employee compensation. You're going to receive that if they are doing things properly and running as a legitimate company. They should have asked you to fill out a W-9 just to confirm your information and details, because they will issue you that 1099. Just like that business is trying to claim deductions, that money has to go to somewhere else and somebody else has to claim that income. The IRS understands that. Debits and credits, in and out, money going in and out. Money goes out of their account into somebody else's account. It has to land somewhere, and them filling out that 1099 shows that, hey, here's my deductions. Here's the contractors I paid for this work. They're going to claim the income. And if you are doing some sort of service or a developer and you're receiving that, that is considered income. If you made it this far, good news. This last red flag that we see is commonly very fixable, but only if you catch it before filing your tax return. And that is simply claiming losses as a deduction when your crypto is stolen. Depending on how long you've been in the crypto market, you're probably very familiar that crypto scams are through the roof. Okay, scams are constantly happening simply because, we all know that once it happens, it's not reversible, and there's no customer support line where you can call to get some help to recover your funds. So crypto scams are through the roof. And if you've been a victim of this, I'm very sorry to hear this. And to give you more bad news is you are technically not able to claim that as a deduction on your tax return. Okay, it just simply means that somebody stole your income, and you can really do nothing about it. Because if we relate this to the real world, if you leave your laptop in your car, someone breaks into the car, steals your laptop, are you able to claim that deduction? Technically, no, right? Like, even if it's a business laptop, you've already claimed the deduction before, already on your business taxes, right? You can't claim another deduction. And this is a huge problem that, is very, sad to be a part of within the crypto community, but is very common where people are getting their crypto stolen. This is not allowed unless you are in a Ponzi scheme and an indictment has occurred. That is one of the scenarios where you are able to claim your losses at that point, because now it's, in court and there was an indictment. And in those cases, you're pretty much good to go depending on the scenario further. You'd have to get tax advice and tax counseling to see if you are able to claim those losses. And this is very common, and the IRS will disallow it because, again, it just simply means that your crypto is stolen, and these deductions for claimed losses doesn't work. So those are the 5 big red flags that the IRS is watching for from crypto investor. Here's the key. If you are documenting everything properly and understanding what's a taxable event, what's not, how to claim the losses, if you should claim your losses, then most of these problems that that are coming up should be resolved before they even happen. Crypto taxes doesn't have to be stressful, and if you understand and are aware of exactly what the IRS is looking for, you can stay one step ahead of them. If you found anything in this video today useful, please like and subscribe so you can get more crypto tax content straight to your door and keep more of your money inside of your pockets. See you in the next one. Bless.